So you guys can send your questions into the chat right now, and the coaches are going to be here answering all your questions. And we're going to go through them one by one, and Theodore is going to be the one that is going to be asking the question to us, right? So let's get the first question in the chat right now. So ask us anything.
Alexander asked, do you trade using the Wyckoff method?
The what method? No, I'm just kidding. Yeah, we don't do that, bro. We don't do any of that, bro. Trust me, whatever we have, whatever you're gonna get, at least, bro, whatever you're gonna get from the 1% club is one of one. It's something that you cannot, any of the concept that you're gonna learn from the algorithmic, you find it out there, I'll pay you whatever money, bro. That's the deal from my side. It's nothing that, you know, like others, how they like repackage and resell. It's nothing like that. Everything is proven with proper track record, with a lot of, you know, success from the students. That's basically what we trade. Mainly the objective of the market, the liquidity, the imbalance, the efficiencies.
Yep. Yeah, just to add on to what Jason said, I personally don't trade using the Wyckoff method as well. Like, if it works for you, it works for you. My approach, like I shared with you guys yesterday, is more based around like a mechanical trading system that is focused on market structure, liquidity concepts, order flow, institutional zones, and just risk management, right? So like I said, I prefer like a much rule-based strategy that can be consistently repeated and scaled, right? Because like I said, if you can't repeat it, right, you can't replicate it, you can't scale it, right? So that's from my side.
Got it, guys. Thank you. Let's move on. Mal asked, how do you manage risk reward if your entry isn't so great? And how do you manage your scalp trade where what is your entry?
Okay, when it comes to risk to reward, obviously your question here, you said that entry isn't so great. It means that there is something wrong. It means that obviously, you know, it was some kind of FOMO entry, forced entry, right? It means that obviously before taking any trade, you should have calculated the risk to reward beforehand. You should have calculated the risk beforehand. How to calculate risk, if you were to ask me? You go to a website called babypips.com, the easiest way to do that, yeah? Go to tools, there will be position size calculator. Go there and like actually calculate your whatever account balance you have, put it out there, whatever percentage you want to risk, put it out there, and then calculate. It will tell you exactly what lot size to use in order to risk how many percent or how much money per trade.
I would just add one thing to this, kind of bouncing exactly what off Jason said there, which is, I think the question here shouldn't be how do you manage risk? It's why you're getting into positions when your entry isn't great to begin with. If there's something underlying here that's making you rush entries, getting into positions which don't fit with your edge, this is something and an opportunity where you can ask those questions as well. We're more than welcome to give you some feedback. So again, something that I always encourage is just starting to dig beneath the surface. Don't look at the surface level problems, understand why the problem actually exists. But just 2 cents.
Got it. Awesome, guys. Thank you. Tim is asking, how much money can I make by starting $1,000 each month?
There is no certainty into trading, but I'll tell you that, man. A good trader will be looking at 3 to 5% a month. So instead of you like putting $1,000 into your live account, why not, like, once you have like proven strategy in that, you have enough data to actually back you up. Why don't you go like buy a 100K account that costs you like $500 prop from 100K account, right? Because like 5% of 1,000, that's like what? That's like $50. So, but like 5% of 100K though, that's $5,000. You get to keep 80% of that. I mean, that's not bad money, you know, especially if it's something on a side.
I would also just add, Tim, I think the focus point here is just off in the sense that you have to understand as a trader, you can never control how much money you make. Despite your goals, your dreams, your ambitions, you have no control after you click buy or sell. And so that means on some months, you're going to make money. Some months you might make a lot of money. Some months you might even lose money. And if you're only focused on trying to achieve a certain number as a return, whether that's monetary, whether that's the percentage, you're setting yourself up to fail. The one thing that I have found, most professional traders, they focus on one thing, executing their strategy. Everything after that is just a natural byproduct. And I think if you focus on that element of what you can control, you'll find there'll be more consistency with your actions longer term.
Yep. And also, like, it really depends on what route you go to like whether you go for the funded route or whether you go to start your own live account. If you go to the funded route, you know, you start with $1,000 a month, you can potentially get like a 100K account, right? And then obviously you're gonna make different returns compared to if you just have like a $1,000 small life account where you're able to risk like a small portion, make a little bit of money. So it really depends on your specific like circumstances and what you do with that $1,000 itself. Yeah, but completely, Jason and Sanjeev absolutely knew it.
Awesome, guys. Thank you. Rita asked, do you rely more on technicals, fundamentals, or a mix of both?
I personally, mostly technicals, like generally mostly technicals, but I do look out for fundamentals like before they come out, right? So I don't really trade based on fundamentals, but like I said, you got to develop your own edge, right? But for myself personally, it's about 90% technicals, maybe even 10% fundamentals. Like it's still good for you to understand like what's going on in the market, why price actually moved the way it moved. Like for example, what's the impact of tariff on the currencies or on the stocks market itself?
Okay, on my side, obviously, I scalp. I focus more on the scalping. And to be honest, I don't know anything about fundamentals, man. I actually don't know. I tell you that. I do, mainly because I don't really care about it. Because I focus on catching the short-term moves, not the on something on the long term. I don't really care about that. What I care about is what, let's say, Euro USD is gonna do at the first hour of London or second hour of London. What is it gonna do? How can I capitalize on that particular 1 hour candle? That's that. So like my trades, it doesn't last days. It lasts from hours to minutes. So yeah, for me, fundamentals, I don't really care about it.
Got it. All right, cool. Moving on to Federico's question. I realized during your trading videos, you open more than one position with different lot size of same currency pair. Why of that? Or why is that, I think?
Now, the main reason is because like I have to stack different lots. Okay, like right now, I'm trading like a multi six-figure account, right? So if I'm risking 10K a trade, let's say I'm risking 10K a trade, and I go to my position size calculator, I input my stop loss, and let's say it's like 5 pips away. Dude, that's like 300 plus lots, or like, I don't know, 250 lots, or 160 lots. In that case, when you go into MetaTrader 4, the maximum lots per position is 50 lots. So if I need to trade with 167 lots, I have to separate into 50 lot, 50 lot, 50 lot, and 16.7 lot. That is why more often than not, when you see my trades, I got 4 different positions, but it's the same exact trade ideal, right? But it's because I have to just segregate it based on my risk per trade.
Gotcha. Gotcha. Awesome. Cool. Hubert asked, if, for example, 1,000 people trade on one mechanical strategy, does this change the strategy?
Bro,
It will never. It will never.
you're a small fish, bro. Like you are genuinely nothing in this market. Even 1,000 people is nothing, bro. Unless it's like 1,000, I don't know, billionaires. Then maybe something will change. I don't know. Maybe.
Let me put you guys into perspective. Yeah, on a daily basis, what is the market cap of Forex? More than $6.7 trillion that's being traded on a daily basis. Yeah, and 90 to 95% is controlled by the banks, basically the big fish, man. And then who are like we to like be able to move the market? That's not how it works.
Yeah.
Gotcha. All right. So for currencies like USD, Japanese yen, how do you calculate pips, especially for 2 pips stop loss as advised?
Okay, so it's the same for any Forex peers. Everything is the same. This the way you calculate your pip is the same, except it is somewhat different from gold and different from Nasdaq and other indices, though. But Forex, everything is still the same. But I don't know what USD JPY you guys are be looking at, but 2 pips of stop loss in USD JPY is that's kind of too tight, bro. I can't lie.
it's too tight. Yeah, it's too tight. Yeah, man. Like the yen pairs are a little bit volatile. I'll say minimum like 3 pips ish. And also you have to take into account spreads as well for your individual broker.
No, yeah, 100%. And plus, like, there are no brokers that offers raw spread for any Japanese yen peers. They always have spreads.
Yeah.
Got it, guys. Okay, what if liquidity sweep fails? Can we plan opposite side trade?
Okay, it's funny you actually brought this up because I actually traded live today and I just released like that video on my second channel. What happened was that I actually entered for a long position on Euro USD and I got all the liquidity sweep in the world, right? I'm talking about we got ego lows being swept, we got a strong swing low being swept. So all the available liquidity has been taken out. And in my playbook, I felt like that was a high probability trade setup, right? So I executed, I entered into the position, entered for a long, and I got stopped out. I got stopped out, even though everything checked off in the boxes, I got all the liquidity being swept. And then guess what? The internal order flow shifted from bearish to bullish. No, bullish to bearish, right? At first, I wanted to look for longs, but then price ended up taking that swing low, right? So price started going down even further. That is where I realized that, you know what, fuck, I was wrong about my trade idea. The market is not bullish. So instead of, sulking about what should have, could have, or would have happened, I switched my trade idea, right? I adapted to the market. I became like water, right? So I actually switched to a sell position instead, right? So because of the fact that in the internal order flow I shifted bearish and I want to trade with the internal order flow, I entered for a sell. And I end up banking about 30K on that trade itself, which makes up about the loss. So we end up about 20K net profit. And it's all because I was fast enough to actually adapt to the market itself. Like I said, guys, the biggest strength of me as a trader is that I have no ego whatsoever. I don't feel the need to be right. I don't feel the need to actually prove myself to the market. That's what trading is about. You got to put your ego aside and just focus on what the market is actually trying to show you.
Okay, from my side, obviously, in order for you to actually adapt, like, what Brad said, is to actually plan it, pre-plan everything before, right? Whenever you analyze, this is something that we always talk about, like in the 1% Club, where like if we're analyzing some chart, if we're analyzing any kind of market, we always make up scenarios, right? We make up two scenarios. If it were to go bullish, how should it deliver from where till where? And if it were to do that, then only we're going to be part of it. And if, let's say, that bullish were to fail, and then it starts to deliver bearish, we will only be part of that bearish move if we anticipated that beforehand, if it was pre-planned. If it wasn't pre-planned, you best believe 100% of the time it is just going to be a FOMO entry.
Yep.
Got it. Awesome. Moving on. Question to Jason. How come you don't create video content like Brad?
Bro, I can't lie, man. I don't have the mental capacity, bro. I'm gonna be very honest here, bro. I don't have the mental capacity, man. I have shit ton of stuff to do. I mean, people in the 1% Club, they know it already, bro. I'm just not just like a full-time trader. Like, I have a lot of stuff to do. I have a lot of responsibility. You guys might know me as just like, a simple guy who just dropped out of uni and he's 24, 25. But the amount of responsibility I got on my head is actually crazy. But yeah, mainly I just don't have the mental capacity. That's why I don't create videos.
Got it. Awesome. All right, this one is an interesting one. How can you work on your emotions when you are sitting in a trade or planning a trade?
So I guess this one is over my way. Girion or Giron, I hope I'm pronouncing this correctly. This is one that I probably need a little bit more information on. And I say this primarily because I don't like to give very generic advice. When I say that, what I mean is emotions is a very broad term, right? I want to know what specific emotions are you experiencing when you're sitting in a trade or when you're planning a trade. The one thing I will say to give a little bit of value and context to this is I think a big part of what most people experience in either of those situations will really depend on their expectations before anything even happens. Where I find most people go wrong with emotions is their expectations of the potential outcome is already flawed right from the very beginning. So the question that I would bounce back, and of course we're here for a little while, so I'd love to hear some feedback from you, is what do you expect to happen during those moments? Because in reality, and the philosophy that I share is that you should be expecting one of three things from any potential moment where you're looking to take action in the markets. You should be expecting a small loss, a small win, or a big win. And the reality is, if you have aligned your mind to truly expect any one of those outcomes and you've accepted them, the market can never disappoint you. Therefore, your emotions will never work against you. The only way you will be disappointed or frustrated or lead to something which is negative in some way, shape, or form is you've either taken a big loss, which means there's an issue with your psychology and or your risk management, or you didn't expect one of those three things. So if you align the expectations to begin with, then in a variety of different situations, you're less likely to experience them. But please bounce back in the chat and let me know specifically what emotions you're dealing with, and I can give you something a little bit more tailored for you.
I love that. All right, cool. We've got another, I think, one coming your way, Sanjeev, from Florence. One of my big challenges is mastery of my emotion. I do not know anyone who is trading, so I have no community support. This leads to self-doubt, fear of loss, internalized demo trading losses, afraid to fail prop firm challenge.
It's a very deep question. So I firstly want to reframe something from the very, very beginning. A lot of the reason that most traders struggle psychologically is they think it's because of emotions. They think it's because the fear of losing. They think it's because of self-doubt. They think it's because they internalize things a certain way, exactly like you've listed. The one thing that I share from my perspective is the problem is rarely ever the actual emotion. It's always how you respond to the emotion. Because the reality is, if you felt fear, if you felt greed or anger or self-doubt, but your response was, I'm going to follow my plan anyway, then actually the emotion poses no problem. So actually, it's not the emotion that's the problem. It's the emotion is just a symptom of the problem. So what I would say is in each one of those situations, what your job needs to be is to unpack why you are feeling those things. Now, from a surface level, I would recommend that there are three things that you really need to help address everything that you've listed there. The first one is community. And I know this one firsthand because I spent a lot of time trying to do this alone. And I can tell you the journey is infinitely harder if you don't have the right people around you or you don't have the right mentors or coaches. This is exactly one of the biggest reasons why we've created this community, because we understand what it's like when you have nobody else to resonate with in this journey. I can't think of many other industries that will take you on highs and lows like trading will. And nobody can resonate with those like another aspiring trader or a coach that has been through it. So the first thing I would say is fix the community aspect. Get yourself inside somewhere like the 1% Club, where everybody there is aligned to achieve the same things. They're aligned to help you to become better than the person than the one you were the day before, and to improve all of the elements that are holding you back, right? So that's the first thing. The second thing is confidence, right? You need confidence in your strategy to remove that element of self-doubt. You need to be able to develop the mindset to think in a probabilistic manner to understand things are not going to work all the time, but over a large sample size, things will. And that starts to remove a little bit of self-doubt. The last thing that I would very briefly touch on is detachment. You have to understand this whole element of being afraid to fail a prop firm challenge. Take this from the guy that worked in one of the biggest prop firms and coached multiple traders inside of that space. Failing a prop firm challenges means nothing. It means nothing to do with your long-term performance in the market. I have seen many successful traders fail a challenge, but it doesn't mean you can't make money. I want to remind you today that if your goal is to get funded, you're focusing on the wrong thing. The goal is not to pass a challenge. The goal is to get paid. That's a very, very different job psychologically. And what that means for you and how you act towards the market is a completely different thing the moment you start shifting that goal. So Florence, just my 2 cents.
Awesome. I love that. All right. Rita asked, do you use any tools or platforms for macro analysis, Bloomberg, Reuters, Trading Economics?
Me personally, I just use Forex Factory, and I'll use Bloomberg from time to time to like look at the news. But honestly, there's so many free resources out there nowadays to do your macro analysis that you don't really need like to pay, I don't know, hundreds of thousands of dollars for Bloomberg, honestly.
For me, I only do Forex Factory just to check like what time. I mean, right now at this point, like it has become muscle memory. I don't even check like what time the news, what kind of news today we got. I know it already. Every first Friday of every month we have NFP. That's something we need to know. Second week we have CPI, and then last week we have FOMC. It's just the same all over again. So I don't really use anything now.
Got it. All right. Jason's question for Brad. Do you prefer an aggressive or conservative stop loss, and why?
I don't get what you mean when they say like aggressive or conservative stop loss, but If it's me personally, I just like to place my stop loss at like a level which will invalidate the trade ideal. And then I will make sure that I have like some form of buffer with to it, like so that it can account of spread. So for example, if I'm entering at like a high priority institutional zone, entering for a long, I'm going to be placing my stop loss below the zone itself. And I'm going to make sure that it's not right below the zone. I'm just going to be placing it, maybe like give it a little bit of buffer, like 0.5 to 1 pip buffer below the zone itself, right? So I don't know whether you consider that as aggressive or conservative, but that's how I personally trade. Yeah.
I think what he meant by aggressive is basically, let's say if we were to have an entry from an imbalance, you just put your stop loss maybe randomly above an imbalance. That is maybe what he meant by aggressive. But no, we don't really do that. At least what I do is, obviously I do the same as Brad. My stop loss will always be at a point where it will completely invalidate the trade. If let's say my stop loss got hit, it means that, well, yeah, my bias is just wrong, or I just caught the wrong direction of the market.
Got you. All right, moving on. Rita has another question. How do you manage trades that are going against you without panicking?
So I think I'm hoping you guys are gonna start to understand I have a particular theme with how I respond to questions. My initial response is, why are you panicking, right? This is where I start saying you have to start digging beneath the surface. So my initial thing is always understanding why the emotion actually exists. When a trade is not going your way, your mind goes into fight or flight mode, and you start discovering your own inner demons, your inner insecurities about what you're worried about most. So Rita, the thing that I would ask you to reflect on is, what are you more attached to in that situation? What is causing the emotion? Typically, it's going to be one of two things. Either you have a fear of losing money that you're risking in that particular position, or you have a fear of being wrong. Now, depending on which underlying issue is driving that emotion will completely change how you fix the problem. If you don't know which one you're attached to, the quickest way I recommend people trying this is take the next maybe 1 or 2 weeks and demo trade, right? Go back to trading live market conditions, but in a demo environment. What that does is it removes money out of the equation. Now, if your issue still presents and you still feel panicked, that means you have an attachment to being wrong, because money is no longer on the line. So you have an attachment to being wrong. And what you need in that situation is your mind and your body telling you that you need more confidence in your strategy. Because if you have confidence, you have the right expectations. If you have the right expectations, you've seen this play out. You've seen trades move against you, and you understand if it stops you out, it's not the end of the world, or sometimes it might just turn around and pick up and go fine. If the emotion disappears when you demo trade, then you realize you have an attachment to money. And that tells you one thing: you're risking more than you're psychologically able to handle. So what I would recommend, drop your position size. Start with half of what you're currently risking and see how you feel. Now, one nuance I would quickly add to this is a lot of people don't like the advice of reducing your position size, because the obvious thought is, well, when I win, I'm going to make less money. What they don't factor in is, if you are able to stay more psychologically grounded and maintain a position of equilibrium, what I like to say is, even though you will make less money in your winning positions, you will stay more consistent with your approach. Because right now you're probably making a little bit of money and then giving it away during these moments. When you're more consistent, what you're going to find is you're going to make less money in each position, but you'll be more consistent with having those winners. And that's how you compound and grow your account over time. Hope that answers your question.
Yeah. In terms of technicals, I would like to add something as well. The way, managing the trade that goes against you without panicking is honestly understanding, basically pre-plan every single move. If let's say, you're in a trade right now, this is something that we do it on a weekly basis during live trading. Yeah. Whenever I take a live trade, let's say a trade were to present itself and we were, doing the live trading session, and I would take it, I would monitor the price delivery one by one. That's not for everyone, but that's how I do it. And then I expect, let's say if it breaks a certain low, if it makes this kind of move, it means that it's a strong price delivery for, let's say, bearish or bullish, right? There's a concept of strong and weak price delivery. If the price delivery is weak or something, I'm maybe moving stop loss to break even, maybe, closing the trade. Or maybe the time is telling me that, maybe a new 4-hour candle is about to open. There will be huge retracement in that. So I'll be closing a trade. So basically, in a nutshell, what I'm trying to say is pre-plan every single thing first. If you were to pre-plan every single thing, then I don't think like you're gonna be panicking on a lot in terms of technicals at least. Right. That's why like a lot of, again, the advice that I give is not for everyone. A lot of people, they like to do the concept of set and forget. But honestly, I just cannot do that. So that's why that's what I do.
Awesome. Thanks, guys. All right. So moving on, Ma, as an institutional trader once told me that if you are new to trading, you shouldn't get funded in your first 2 years. What do you think, Lo?
Okay, Ma, with all due respect, that's the most stupidest shit I've ever heard. Generally, with all due respect to the institutional trader who, I don't know, been trading for 10 years, managing millions of dollars, with all due respect, that's the most stupidest shit I've ever heard. Yesterday, you have seen on our webinar, there is hundreds, if not over thousands of traders who we have coached, got funded within 6 to 12 months and got payout 10K a month, 20K a month, 30K a month, 40K a month. So if today you were to listen to the institutional trader, then you're going to be stuck in where you are right now. And you're not going to get funded until 2 years later. Bro, by 2 years later, if you have the right framework, right, you could have been making like, I don't know, 50K a month if you're able to scale up properly. So I would say you can take 2 years to get funded, right? You can listen to the institutional trader. You can take a little bit longer than the others if you don't have the right support, you don't have the right guidance, you don't have the right mentor, you don't have the right community. It's gonna take you that much time to figure everything out via trial and error. But if you do have all of these things, bro, 6 to 12 months, we're gonna get you there.
Yeah, from my side, I would like to add something like this, man. Honestly, in any industry or whatever you touch, yeah, never ever compare yourself to anyone, right? Don't think that, you know what, that guy is good, man, I can never beat him. No, bro. At first, you're not supposed to even look at that guy, bro. Like, you should focus on your own journey. I'll tell you this, man. When I started trading, right, first year into trading, bro, swear it down, God is looking at me, yeah. First year into trading, I was already paying my bills. I'm not even joking, bro. Even though the concept was as simple as support and resistance, supply and demand, but the risk management was there, showing up every single day, taking trades. It wasn't just me taking trades in front of hundreds of students on Brad's Discord, right? Hundreds of students. I actually we have a track record for 3 months. 1 year into trading, three months track record where we actually went profitable, right? Main thing is that I never compared myself to anyone. The guy who introduced me to trading, he has been trading for 4 or 5 years. He didn't find any consistency. If I were to like compare myself to him, I'm like, bro, I don't know, bro. Right. So that's why I'm saying you're not supposed to compare yourself to anyone, bro. You are you.
Got it. Thanks, guys. All right. Another very interesting one from Joao Neves. Or Neves, sorry if I'm butchering your name, man. How do you deal with repeated A+ setups that you end up losing like all week with losses?
I'll start with this purely from a psychology perspective. So one thing that I focus on a lot inside the 1% Club is that you can fix a lot of psychological problems by truly understanding your data. Now, I'm going to make a couple of presumptions here. Firstly, you've mentioned A+ setup. So I presume that means you're sticking to your plan and you're executing on high quality setups, right? I presume that is your A+ setup. Now, I want you to remember, and this is something that you can gain just by purely understanding data and math and a little bit of statistics, right? If you have a 50% win rate, which, by the way, is pretty decent as a trader, right? You can make a lot of money with far less than that. But let's say you've got a 50% win rate. Statistically, over the next 500 trades, you are likely to encounter 9 losing trades in a row. Not just 9 losses, 9 losses in a row. That means you show up, you meditate, you journal, you take a cold shower, you do all the shit that you're supposed to do, and you could still take 9 losing trades in a row, right? What that means is your edge isn't broken. Your strategy isn't failing. It's just part of probability and statistics and a little bit of math. You combine these together and you start to understand this is how things work in a probabilistic environment. So when you're asking, how do you deal with them? You accept right from the very get-go that this is my win rate and this is my expected period of a losing streak. If we start to go over this, that's where I would say, start to question it. Are you doing the right things? Are market conditions at a point in time where maybe you haven't tested? If not, if you're getting worried over 4 or 5 losing trades in a row and your data is telling you that you could take up to 9, the problem is not strategic. The problem is psychological. And the problem is you didn't manage the expectation right from the very get-go. So I hope that answers your question.
Now, just a quick one from like a technical standpoint. If you are executing your plan, right, and your plan says that it is indeed an A+ setup, the buy right, man. I hate to tell you about it, but you shouldn't be losing every single week. Like generally, if it is indeed an A+ setup, you shouldn't be losing every single week. So I'll say, first of all, go and clearly define what exactly is an A+ setup for you. Once you got that in place, then you know exactly what to look for, right? And once again, this is not something that you can find after 10 trades or 20 trades. It's something that you have to find after backtesting 100 trades or even 1,000 trades, right? So go and clearly define what counts as an A+ setup to you, and then use data to actually back that up, right? Provide you evidence that that is indeed an A+ setup, and then go from there. Yeah, then you can start focusing about psychology, like what Sanjeev have mentioned.
Got it. Thank you. Next question. Is it possible to show us how to identify fair value gaps in supply and demand zones?
Quick one. Wait, let's just, what's the question? What is, okay.
Is it possible to show us how to identify fair value gaps in supply and demand zones?
We would do all the charting stuff at the end, like if you got the time to do so.
Got it.
Okay,
Okay.
right. But Shokti,
Yeah.
I got a video on this on YouTube. Just go search supply and demand trading, the trading gig. You'll find it all there. Fair value gaps as well. Yeah,
Yeah.
Johnny.
All right. Johnny's question: what's the time frame should we use if we have to go for swing trade 2 to 4 weeks?
I'll say daily as your higher time frame, 4 hour as your medium time frame, and you can use 15 minutes as your lower time frame, or you can even use 1 hour as your lower time frame if you are trying to hold it for like 2 to 4 weeks. Obviously, you can also use 4 hours as your lower time frame since you're holding for that long. But yeah, those are the set of time frames that we generally recommend our students to use for swing trading.
Got you. All right. Frederico's question. By the way, guys, I think we're kind of running low on time, so I'm just going to ask a couple more questions. What is the ideal back period of analysis when reading the market structure from top to down time frame?
Honestly, there is no set one. There is actually no set one. Why am I saying that there is no set one? Because every single chart, whenever you open, it's a unique one, right? Let's say I'll tell you like my strategy in a nutshell, right? I hop on a chart, I open a daily time frame, and then I look for an external structures. Those external structures are basically external liquidities. External liquidities are stronger than internals, right? So meaning that I'm only trading after a certain external gets taken, right? So that external can be last week, it can be last year, it can be 5 years ago, right? It depends where is that external that I need to find. So I cannot really tell you exactly where you should go, like till where you should be going. All you need to find is basically the closest objective. In short, the closest external, for me at least, the closest external liquidity that has an imbalance. That's that.
Awesome, thanks. What do you think, guys? We have time for one more? Okay. So Tim asked, how do you validate supply or demand?
I'll tell you this, man. Every single zone, if there is no liquidity sweep, there is no imbalance, it's not going to be that valid, right? Supply and demand is a zone, and order block is one single candle, right? So any zone or any order blocks, if it doesn't have any imbalance, doesn't have any liquidity sweep previously, and followed by a breakout structure, that is low to medium probability zone, you want to call it.
Yeah,
Got
I'll
it.
say 3 main things. It must lead to a break of structure. It must be unmitigated. It must have some form of imbalance, and a bonus one would be it must have some form of available liquidity like sitting near it. I'll say, yeah, these 4 things. Yeah.